Market structure is a key and fundamental aspect of technical analysis, arguably one of the most important. It gives you context, direction, and trend for your trades. Price can go in one of three directions: up, sideways, or down. We have trend identifying patterns for bullish market structure and for bearish market structure. In the case of bearish, we have our high, our low, our lower high, and our lower low, thus confirming bearish market structure. In the case of bullish, we have our low, our high, our higher low, and our higher high, thus confirming bullish market structure. And then, of course, continuation. There's also consolidation. Consolidation comes at periods of pause from either a downtrend or an uptrend, before then continuation or some degree of a reversal. There's an old saying that the trend is your friend. That is to say that as you're trading a trend, you should expect it to continue. That will become very important for when price comes to reach this area. If we're going to trade the trend, we have our high, low, lower high, lower low. We should expect another lower high here. However, we do have bullish market structure on a lower time frame, to which we can look for to see a possible market structure change by getting a move up, thus giving us our high in the pattern, our higher low, and then our higher high, confirming market structure change.